Welcome to This Explainer. Today, we're going to completely transform your mindset. Seriously, we're shifting gears from just thinking about, everyday spending to actually mastering the art of strategic corporate financial planning. So let's just dive right into this because honestly, whether you're managing a household budget or steering a massive corporation, the principles we're exploring today, they are the absolute bedrock of success. I want to start by throwing a direct question your way. Imagine you have 10,000 rupees, or, if you're thinking like a massive corporation, 10 million just sitting right there in your hand. Would you say you have money, or would you say you have finance? It kind of sounds like a trick question, right? But believe it or not, the distinction between these two concepts is literally the foundation of everything we're about to explore. See, if you take that 10,000 rupees and just spend it on daily needs, like groceries, vegetables, maybe some clothes, you simply have money. You spent it, it's gone, and there's absolutely no financial return. But if you take that exact same amount and put it into a savings vehicle, like, say, a corporate term deposit, well, it suddenly transforms into finance. Why? Because you've deployed it with the explicit expectation of generating a return. Finance is entirely about the management of capital with proper strategic intent. So here's our roadmap for today. We're covering money versus finance, the evolution of the discipline, key financial decisions, how finance compares to other disciplines, the ultimate battle of profit versus wealth, and finally, risk and return. All right, part one, money versus finance and the power of intent. When we combine financial resources with management functions, we arrive at the concept of financial management. Simply put, it's a management decision that results in two absolutely critical things: getting or procuring the funds, and then the optimum utilization of those funds. You have to get the capital, sure, but the true magic happens when you actually put it to work in the smartest, most optimal way possible. It's the absolute lifeline that determines whether an organization thrives or just, withers away. Moving right along to section 2, the evolution of finance. Now, this discipline has dramatically shifted over the last century. If we look back at the traditional phase, that's roughly from 1900 to 1940, the focus was entirely on just procuring funds, like how do we get a bank loan, how do we issue shares? Actual strategic decision-making kind of took a backseat. Then came the transitional phase in the 1940s, where everyday operational problems pushed managers to finally start, planning and controlling a bit more. But the real game changer, that's the modern phase, from 1960 to the present. We completely moved from simply keeping the lights on to complex, data-driven optimization. Today, the focus is heavily on maximizing the wealth of the shareholders through highly logical, deeply strategic analysis. That brings us to section 3, key financial decisions. I like to think of these as the three main buttons on a corporate strategist's control panel. First up, the investment decision. This is deciding exactly where to deploy capital. It could mean choosing long-term assets, which is known as capital budgeting, or managing short-term current assets, known as working capital management. Second is the financing decision. Once you know what to buy, how are you going to pay for it? This involves finding that perfect mix of owners' funds, like equity, versus outsiders' funds, like debt. And finally, the dividend decision. If the firm actually makes a profit, the manager faces a big choice. Do we retain these profits to reinvest and grow, or do we distribute them right back to the shareholders as a dividend?
Okay, section 4, disciplines compared.
Here's a pretty stark, real-world contrast to show why finance is so unique. Let's take the accounting view, which mostly reports on the past. Imagine firm X shows sales of 10,000 rupees and costs of 7,000 rupees. The accountant is throwing a party for a net profit of 3,000 rupees. And yeah, it looks fantastic on paper. But the finance view? It relies on actual physical cash flow. Let's say the firm only collected $2,000 in cash from those sales, but they had to pay out $6,000 immediately to suppliers. Guys, that's a net cash outflow of $4,000. So while the accountant is saying you're highly profitable, the finance manager knows you are bleeding cash and about to miss payroll. See, finance goes way beyond recording history. It relies on actual cash flow to make forward-looking, literal survival decisions.
Next up, section 5, profit versus wealth. For a really long time, the main objective for any business was simply profit maximization. And sure, it measures performance, it measures efficiency, but the whole concept of profit is actually dangerously vague. Like, are we talking about profit before tax or after tax? Worse, it completely ignores the time pattern. Making $100 today is not the same as making it 3 years from now, thanks to inflation and opportunity costs. And perhaps most dangerously, chasing more profit without factoring in the risk and uncertainty of those returns, that is a massive trap that has sunk countless companies. And that leads us to the modern, universally accepted approach, wealth maximization. This is a brilliant concept because it aims to maximize the net present worth of the firm's shares. It's unambiguous, it factors in risk, it heavily considers the time value of money. So instead of just chasing a quick, vague profit, wealth maximization looks at the entire stream of cash flows expected over a period of time, discounted back to the present at a rate that reflects the exact risk involved. This isn't just some academic theory. It's the ultimate North Star that's going to guide every single investment, financing, and dividend decision you'll ever make. Moving into our final concept, Section 6, Risk and Return. Consider this fundamental trade-off that every strategist faces. Suppose Miss A invests 10,000 rupees in a fixed deposit at 6% annually. She earns a guaranteed 600 rupees. The risk is virtually zero, but her return is strictly capped. Now, what if she puts that same $10,000 into shares of Firm X? Well, the dividend heavily varies. Firm X might perform poorly, and she might literally get nothing. Because the risk is significantly higher, Miss A naturally expects a much higher return to compensate for that uncertainty. That's the golden rule in finance right there. Greater risk demands a greater expected return. A finance manager is constantly walking this tightrope in every single decision they make. So let's pull all of this together. The finance manager's day-to-day role is incredibly multifaceted. The major functions involve precisely estimating capital requirements and then properly allocating those funds to maximize wealth. But they also handle a whole bunch of secondary duties, maintaining optimal inventory levels, financial forecasting, ensuring liquidity, and even decoding the psychology of institutional investors. It's a huge job. It requires sharp analytical skills, relentless market awareness, and tremendous foresight. We've really moved from the simple concept of just having money in your pocket to the complex art of modern financial management and wealth maximization. You've basically seen the mechanics behind the curtain of corporate strategy today. So I want to leave you with this final, somewhat provocative thought. Whether you're analyzing a Fortune 500 business or simply evaluating your own personal investments, how are you going to balance risk and return in your next major financial decision? Thank you so much for joining me on this explainer. Keep strategizing, and I'll catch you next time.